All right, let's go ahead and get started. Good morning and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the broader market. Before we get started, our usual disclaimer: the types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So the agenda for today will kick off with the major equity indices. We know the S&P and the Nasdaq are at all-time high territory. However, what we are looking at is potential pullback zones because we are seeing signs of a retracement lower here in the last couple of days. So we'll take a look at areas the price could potentially pull back to offer you a better risk to reward bullish entry point. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a few subsectors of interest, and we'll end today's webinar with some of the bullish and bearish market observations that we've had over the last few weeks. So the S&P 500, looking at the SPY ETF, price is looking quite extended to the upside here, the 50-period CCI approaching that 200 overbought condition. But the bullish thesis still remains intact. We had some, I would say, slight bearish or neutral price action when prices at around at 485, between 485 and 490. Yesterday did have a good bit of bullish price action, but we are set to open a little bit lower this morning. Now, this week is going to be a week plagued by fundamentals. We have big tech earnings, we have a Fed interest rate announcement, and of course, we have non-farm payrolls on Friday. So those are all huge catalysts in terms of where price could head towards in the short term. Starting off with tech earnings, we have Microsoft and Google today, as well as Apple, Amazon on Thursday. We also have AMD this week. So there's a few big names here, and also Meta on Thursday. So there's a few big names for earnings this week, and big tech earnings week tends to set the tone for the rest of the earnings season. So we do have to keep an eye out on that. All of these names, especially collectively, make up a big weighting of the S&P and the Nasdaq 100. So they do tend to move the market quite a bit. So with earnings aside, we also have the Fed interest rate decision tomorrow. And we know that interest rates are going to be kept steady for this meeting. There's no doubt about that. However, what we are looking for is any forward guidance regarding the March meeting. Now, a month ago, there was a 78% probability of a 25-point cut for interest rates. And in the last week or so, that has now dropped to 48%. Despite that, equities have actually continued higher, which does show the resilience and obviously the rotation into technology that has caused the major indices to move higher. But the hawkishness or the dovishness of the Fed that's going to be gauged tomorrow will likely impact the short-term move here for equities, because that's going to have a bit of a longer lasting impact as well. And it really does come down to the question, are we going to get an interest rate cut as early as March? And the Fed will most likely, refer to additional data points that come out. So non-farm payrolls next week. This week, Friday, will be one of them. Any inflation data coming out this week, and next month ahead of the next Fed meeting. Those are the data points that they are going to be looking at. But what investors will be looking for is how hawkish or how dovish the Fed are based on their comments. So keep an eye out for that. That will likely cause a good bit of volatility to add to what is already going to be a very volatile week. And then non-farm payrolls on Friday, again, largely dependent on what the Fed says on Wednesday, is how we will view non-farm payrolls on Friday. So far, a lower than expected non-farm payrolls number has been good news because it indicates less labor inflation. And that may start to switch because we are still looking for the potential soft landing where we have a high interest rate environment, but can still avoid a recession. So you may start to see the shift where investors are now looking at potentially a higher non-farm payrolls number as good news. So that's what we're looking at from a fundamental perspective. Lots and lots of macro or fundamental impacts this week. So this may be a week where you want to sit on your hands a bit more, kind of monitor your positions, your existing trades, and be ready to close them if needed, depending on the earnings or the interest rate decisions. So in terms of key levels, if should we get a pullback for the S&P, the key level that I'm looking at is really this 475 area. That has been a previous level of resistance, that area between 480 and 475. But we also have some additional support between 470 and 465. So those will be the two key areas that I'm looking at. I don't expect price to actually break below those two levels. We are clearly in a risk-on environment. There's very good news in terms of semiconductor performance for the rest of the year, which is providing a pretty big tailwind here for the S&P 500 as well as the Nasdaq 100. So Nasdaq 100 still comfortably in that all-time high territory now at 430, but we are looking at potential pullback zones at 410. That could be the next key area of support. We also have some minor support at around 420. Nasdaq 100 showing some outperformance, but also approaching an overbought condition here on the 50-period CCI. So keep a lookout for that pullback. And, based off of 2020 and 2021, when interest rates were declining, the pullbacks that we saw in the equity markets were very, very limited. So you may want to be a bit more aggressive in terms of buying into the pullbacks and not necessarily wait for a very significant pullback. Look for these minor pullbacks as good buying entry points, in my opinion. Okay, IWM, the Russell 2000 ETF. So we're looking at small caps here, and we're looking at small caps breaking above that 196 level finally. We had a few failed attempts at breaking above that level in the last few sessions. Yesterday's price action was solid. Now it's at the 200 area. Major resistance zone on the weekly time frame, but I don't expect it to act as too much resistance here, given that price has already recently broken above that area. Momentum starting to return here to small caps, as you can see with the 6-period CCI. So we should get a continuation of this trend back towards the next resistance zone, which is really the 23.6 fib level at around 210. But small caps starting to rebound finally. TLT, the Treasury Bond ETF, looks like we are starting to see some movements here in TLT to the upside. We had quite a significant pullback ever since price rallied to that $100 level. And now price finding support just below 94, set to open a little bit higher this morning. So in an interest rate declining environment, yields will be declining, which is what we have seen. However, in the last couple of weeks, we saw a pop-up higher in yields, which caused bonds to decline. Now we may see yields continue lower, and that could see TLT rebound back towards that $100 level, although this is very much dependent on what happens tomorrow with the Fed announcements. So keep that in mind. Okay, the US dollar index, lots on lots of consolidation at around that 103.50 level, price unable to break above that level and close above that level. As you can see, plenty of intraday rejections from there. And if yields move lower, we could very well see the dollar weaken and continue lower. But the next key level of resistance is also at 104. So I don't expect to see too much upside here for the US dollar. But again, very dependent on yields. If yields do manage to stay elevated, we could see further consolidation. And if yields manage to move higher, we could see price testing this 104 level for the US dollar. But for now, because the Fed is looking to cut interest rates and the currencies that the dollar is compared to, like the euro, the pound, the yen, those central banks are not in a dovish tone just yet. So the demand for those currencies will be a little bit higher due to the spread between, or the interest rate differential. And therefore, the US dollar is always going to be on the back foot until those banks or those central banks turn a bit more dovish. All right, moving on to gold. So gold at that 193 major resistance zone. It has pulled back since then, but bullish structure remains intact with this ascending trend. Lots of consolidation in the short term, but price actually making a big intraday rejection or intraday bounce yesterday. Looking set for another retest of that 192, 193 major resistance zone. If the US dollar does decline, I do expect to see gold revisit that zone once again. However, that is a major resistance zone, and the risk to reward at that level, should we get a rally, would be to the downside. I'd be looking at more of a credit spread type trade structure here to take advantage of what is very neutral and very choppy price action, and to have time decay working in your favor. But for now, this major resistance level does seem to be holding firm. That being said, price isn't exactly reversing higher or rejecting that level like we've seen in the past. Instead, it is consolidating below it. If anything, it's looking like it may be squeezing that level. Very tricky to trade gold right now. Okay, moving on to oil. Finally, we have a breakout here. We saw price breaking above the $76 level a few days ago. Hasn't quite got to 80, and we are seeing a price pull back here. So energy companies have, because of that breakout, have actually seen an improvement in terms of relative momentum against the broader markets. But let's see how long this lasts for. Is this potentially a false breakout followed by further consolidation? Not sure yet, but there is a lack of fundamental catalysts here to dictate the short-term price action here for oil. So moving on to sector rotation, not too much change from last week. We have 2 sectors in the improving and leading categories and 9 in the lagging and weakening. Nothing actually in the improving or the weakening category. So leadership is very much narrowed, and it is narrowed in technology and communications. These are 2 big weight or large weighted sectors within the S&P 500. So it's no surprise to see that narrowed leadership in technology and communication is still seeing the S&P and the Nasdaq post new all-time highs. All the other sectors in the improving category, in the lagging category, especially our defensive sectors like utilities, healthcare now, and staples, all showing a decline in terms of relative strength against the broader market. And we have the energy sector, after the breakout in oil, starting to move towards that improving category. All right, moving on to some subsectors of interest. Like I said, I'm not really too interested in opening too many new positions this week, given the fundamental and macro events in play. But we are still going to be looking at the last week's names and last week's subsectors and market observations and see how they are doing. So DRIV, the Autonomous and Electric Vehicle ETF. We saw price, move lower, followed by this retracement last week, and we were looking for continuation lower. We saw that the price was rejecting the $23.50 level, so our thesis does remain intact, but yesterday's bullish price action is a little bit concerning. So we'll keep this open for a bit longer. I do expect to see a continuation lower still. Tesla's earnings were quite poor. We saw Tesla gap down significantly, and that is going to have a big impact on this subsector. So let's keep an eye out on this. Let's see if price rejects that $23.50 level once again. And IDB, the biotechnology ETF, we saw a big move to the upside yesterday. There was some consolidation despite price finding some support at 133. That was our thesis for the trade, that price stays above 133. So far, so good. Looking towards to retest that 140 level, but the next major level of resistance would be around 145. So there is still some upside here for biotech. This was more of a credit spread idea anyway, so far it has been working in line with our thesis. Oracle has been a very good winner for us. I know we were bullish when prices at around the 106, 105 level, and there was a bit of a pullback, followed by what has been a very strong rally. And it's essentially completed our thesis in terms of filling out the gap up until 112 to 115. Now that price has reached that level, I think now is a good time to be taking profits. We are seeing a rejection of 116. So again, even though the longer term case for Oracle could be bullish, in the short term, I do think we could be in store for a reversal or a retracement lower. And that may provide a good buying opportunity in the future. So for Oracle, for now, let's take profits on this one, which was a pretty big winner here. Lowe's isn't really working out too well here. We saw Lowe's decline to retest the 210 level, and we were bullish from that point on. Bullish price action there as well to confirm, and it hasn't quite got past that 220 area here. Instead, it has continued to decline and once again retest this 210 area. Also, the price action at this level isn't very convincing for a rebound higher. Therefore, I'd be looking at potentially closing lows early, somewhere for close to break even, because price is back down to where we pretty much entered the trade, but lows just isn't finding that momentum. Momentum is pretty much dead here on the 50-period CCI. Rockwell. So Rockwell Automation, we were bullish on this name, a couple of weeks ago when price was pretty much at 305. It's still there. This was more of a credit spread idea anyway, so the theta is working in our favor. There's a short-term potential for a rally here to 310, which is the next resistance zone, followed by a continuation higher. However, I am liking the look of the longer-term chart, the weekly time frame here, where we have our initial impulse move to 310, followed by some consolidation and a nice retracement lower. It does look to be gearing up nicely for another leg higher here for Rockwell. So this may be a bit more of a longer-term trend, or longer-term trade, I should say. But in the short term, we'll see how it performs this week. If not, we may want to close out this trade for near break even and look for a better entry point for that capitulation higher back to the 350 zone. Okay, C Limited. So C Limited, so far, it is performing quite well. When we spoke about this last week, price opened at 38. There was a bit of a rejection there, but so far, price has actually continued to move higher. There's some minor resistance at around that 42 level, but the next major level here is at 46. So I'm really looking at this name to trade the range more than anything, not necessarily looking for a big breakout and a return to those extremely overvalued multiples when price was above even 100 or even 200, or in this case 300. So price is slowly making its way back up higher here. And with that, that is all I have for you today. Big thank you to everyone that joined me for today's webinar, and I will see you next week, Tuesday, for another market outlook. I hope you all have a great trading week, and goodbye.